Hello and welcome to another weekly portfolio update here on The Last Investor. You're listening to Dan, and today I'm going to be talking about something crazy. I'm going to be giving you a portfolio update, and thereafter I'll be delving into the thorny subject that is Carnival Corp and why I 100% believe in my heart that this company is very likely to go bankrupt. And I'm not saying this because I'm some sort of cruise line hater or one of those other things. I actually own shares in this company, and those who follow this channel know that very well. It's in fact my largest position. So is my fairy tale turned nightmare with this stock about to come to an end? You really have to wait till the end of this video to find out. But let's just delve straight into the portfolio update. I'm up 4% on the whole. I've got £10,566, up £424. And in relation to my individual stocks, my top 7 stocks that I like to look at because they're over £500 individually. First one is Crispr Therapeutics. Crispr Therapeutics in the last 7 days is down 3.5%. They've just released their earnings reports for this year, so they have got some significant news, and I'm not going to delve into any great detail in this video, but I'll talk about it in another video. But for now, just to let you know that some of their drugs appears to have received something called infant approval by the FDA. This is a significant move forward. This company is now moving away from just being a company that's looking in and researching drugs. They're now getting to the stage where they're getting drugs approved. So people are going to start taking them seriously. I think they missed on the earnings and they missed on the revenue, but who cares? It means absolutely nothing. The fact is they're not yet selling those drugs. They're still in the process of they're just about to go into production, and that's when we're going to start seeing the big results and the real big action, and then you'll see some traction with this stock. So I'm 100% bullish on this stock, unlike the Carnival Corp, or the Carnival Corpse, should I call it? Anyways, let's move on. Next stock is Rio Tinto. Rio Tinto in the last 7 days is down 2.7%. Well, I think most stocks this week has been down, including the tech stocks, and everyone was obviously thought the tech stocks are going to fly all the way to the moon, but that hasn't happened at all. The only one that hasn't seemed to have a drop in price is Centamin, and Centamin is up 7.78%. It's on a tear like many other mining stocks out there. They're all on a tear. This is why you should have a diversified portfolio, and that is why I've been buying gold, and I've been literally trying to hedge with other types of diversified stocks. So if techs are going down, gold will go up. If gold goes down, techs will go up. So that's my strategy, and it seems to be paying off, and long may that continue. Now on to the next stock. I've got Aviva, and Aviva in the last 7 days down 4.8%. As I said, most things seem to be going down these days in the last 7 days anyways. And then on to the next one, 3i in the last 7 days. It's seen a little bit of a movement upwards, 0.8%, nothing really significant. And then we have Renewables Infrastructure Group, slightly upwards movement as well, 1.8%, not bad in the last 7 days. And that brings us to our beloved Carnival Cruise. Carnival Cruise in the last 7 days is down 10.2%. 10.2%. Now, the last time that Carnival Cruise hit the £8 mark per share was in March, when we had that dreaded drop, and it's back in those territory, guys. It really is back in those territory, and I'll be going into more detail as to why that is and what am I going to do. Am I going to buy or am I going to sell? Well, I'm certainly not going to buy, but am I going to sell or am I not going to sell? That's the real question to be asked. So that's my update on my portfolio. In relation to new stocks, I did purchase one new stock, and that's Newmont. Newmont Gold Mining is another gold mining company, and I just bought a very small share in it. I will dollar cost average into it. As I said earlier on, my aim is to invest in more gold stocks just to diversify even amongst gold mining companies, just to keep that diversification, because you can't put all your money into one basket, as I'm learning the hard way with Carnival Corp. But having said that, if I'd put my money in 3 different cruise lines, I'd probably be having the same results. But I think the point here is slightly different with mining companies, because different mining companies have exposures to different areas. Some mining companies might have mines in different parts of Africa, maybe in parts of Europe, parts of Asia, parts of the States, North America, and just buying different ones exposes you to different geopolitical situations, potentially risky situations, potentially less riskier situations. So that's the aim and purpose of doing that. Centamin is an African-based mining company with most of its mines probably in Egypt. So I think it's important not to just put all of that basket in that particular mining company, although they're fantastic and they've got a fantastic balance sheet. I think that's the importance of just being diversified overall. Then moving on, I've dollar cost averaged into many other stocks. Livongo is one of them. I'm not going to go into any of these in any great detail. Editas, dollar cost averaged into that. Intelia, Square, Teradyne, Google, all of his stocks, Slack, Bluefield, and Greatland Gold. So I've dollar cost average into all of them. Greatland Gold, just by the way, it's up 123%, and that's after still dollar cost averaging into this stock. My God, this stock is on a tear. It's a gold company, so that's good for me. That's all I can say. Then one other stock I really want to talk about is 3i. Now, I actually recently received a dividend from 3i. Yes, a dividend. Let's take a look to see exactly how much I got paid by 3i in dividends. Here it is. I had a dividend income of £13.65 on the 17th of July from 3i. And I thought, well, they've paid a dividend. Well, I think it's only fair that if they paid me the dividend, that I should reinvest the dividend back into 3i, and that is exactly what I did last week. I couldn't invest the exact same amount because I can't do fractional shares with UK companies, with some UK companies for some reason. So obviously I didn't want to invest just £8 worth when they paid me a dividend of £13. So I said I'll round it up, which is exactly what I did. And so I bought £17 worth of shares just to ensure that dividend, all of that dividend, gets reinvested back into the company. Well done 3i for paying me a dividend in these current climates and current conditions, and I'm going to buy some of your shares for that privilege. So there we are. Now let's talk about Carnival Corp. Let's talk about Carnival Corp, the walking corpse or the cruising corpse. Good grief. Let's talk about it. Now, if you still own this stock, then I feel your pain. And I've got bad news for you, because there's some more pain to come with this stock. Because Carnival Corp is currently sitting on about $20 billion debt, and it's burning through cash of $650 million every month. Every month is having to pay out £650 million. And how much revenue is it bringing in at the moment? Zero. Okay, so this company is bringing in zero cash at the moment and is burning through £650 million a month. It doesn't take a mathematician to work out that it hasn't got long to go to carry on doing that. It can do that for some time, but not forever. So the company also tried to issue some bonds, and it's now rated as a junk bond. The company is rated a junk bond and it can only get 10% yield. It can't get any lower yield than 10%, so it's now having to pay interest rates of 10% per annum on its debts, no lower. And that's the most recent debt issuance that it's had. If it has to go back out to issue some more debt, what do you think people are going to be prepared to pay for it? Yeah, what do you think the yield is going to be then? That's probably going to go even higher. Okay, let's put that aside. The interest that is having to pay on that 20 billion is probably no less than $160 million. $160 million per month. That's $2 billion per year. Incredible. That's what he's going to have to pay. So these amounts aren't insignificant, and that's just to meet those obligations. And the more it borrows, the more that obligation is going to increase in size. It really needs to start opening its doors. And if it doesn't, it's going to stay short forever. Okay, now the other point I want to make clear about this is this. It was supposed to have started sailing in July. That was the plan. They said, we're gonna stay short. We're gonna stay short for a little while, but in July we'll open the doors. I put a video out about that, and then what did we hear? Not so long ago, it came out and says, we're gonna postpone, and we're gonna postpone our sailings till September. So now it's postponed its sailings to September. Okay, that was probably about last month, and I made a comment about that in one of my videos, and it says this is not looking good, and if it has to push it back a little bit further, then this might be spelling some real disaster. And now it's come out in the news that it's now pushed sailings even further out to November. If it pushes sails out to November, and if it sticks to that deadline, there are real problems for this company, because between now and November, just 4 months away, it's going to burn through $2.6 billion. And it's not bringing in any revenue. And if anyone knows anything about finance, cash flow is king. Not cash, cash flow is king. You might have all the cash in the world. If you borrow it, you got to pay it back. What you need is cash flow. Money coming in on a regular basis, not money going out, not you borrowing money that you're going to have to pay back. You actually receiving income and revenue. This company is generating none. It's just generating debt at the moment. So that's a serious problem for this company. And if this carries on, it's really going to be good night, sweethearts, for this company. So, with all of that very bleak news out of the way, what am I going to do about my shares in Carnival Corp? As you can see, my shares are currently worth £500, and I've got an investment loss of £686, obviously unrealized, but that's looking more and more like reality that is going to be realized. And even worse still, the 509 that's sitting in my account as my current investment in this company, it's looking more and more at risk. So what should I do? Should I cut my losses and just keep my £509, or should I wait? Now, if I cut my losses, then of course, if things miraculously, and this really is going to take a miracle now, if things miraculously turn around for this company, then I would have lost the £686 for good, because I would have closed in that trade. But if I stick at it and hold on to it, then that chance, very slim I must say, is still there. But what am I going to do? If I was a reasonable investor at this stage, then I would say just sell. But I'm not going to do that. I'm not going to sell. And it's not because there is a possibility or there's a slim chance that this stock might go back into the green. It's not because of that. The reason why I'm not selling is simply because I want to be able to stare at this. I want to stare at this screen every time so that I learn my lesson not to invest in potentially risky stocks. Because before I invested it, truth be told, I knew that this company's balance sheet wasn't that impressive. It wasn't that good. And I got a little bit greedy thinking, ooh, it's dropped in price. I'm going to go in. And I didn't buy this share at the time when it was like $8. I bought it at the very beginning, prior to just before the lockdown. And I really hadn't appreciated that this could be even more serious than it really is now. As I bought it around February, as you can see, even way before that, much more earlier. I think I bought around beginning of February. At that time, the coronavirus hadn't even come into the UK. It was still a Chinese thing happening in the distance in Singapore and all of that. So we really hadn't at that point appreciated. But the mistake I made was that I should have maybe around March decided to hold fire, rather than plunge in £200 on the 3rd of March and then another £200 on the 18th of March, just to try and save a sinking ship. And this is the price I'm going to have to pay for it. So I want to be able to stare at this so that it is a lesson for me to learn not to invest foolishly like this again. I need to be able to learn from that because I want to see it all the way through. I want to feel that pain, as sadistic as it may sound, but that's the truth. So for anyone who's thinking about buying shares in cruise lines today, and they think that all of this might be some sort of hyperbole by myself to try and make things sound a bit over exaggerated, or trying to overinflate the seriousness of this, believe you me, Royal Caribbean, who is another cruise line company, has already let its Spanish subsidiary go bankrupt, and Royal Caribbean owns 50% or just under 50%, 49% stake in that Spanish subsidiary, and that it's just let that subsidiary go bankrupt. So this issue of bankruptcy may not really happen. Believe you me, it is happening right now. Chapter 11 bankruptcy has already been filed by the Royal Caribbean, its Spanish subsidiary. So if you think this might not be real, trust me, this is real.